I'm Matt Greenberg. I'm the chair of the corporate group at Troutman Pepper, where I focus my practice in private equity. Today, I'm joined by Jeremy Levy, who also practices with me in the private equity practice at Troutman. And today, we're here to discuss different perspectives and the outlook for 2023.
There are fewer assets out there for funds to buy. When they find one that they can buy in a bilateral conversation or a proprietary deal, they're willing to pay, full price, whatever that is, right? Auction price, basically, outside of a competitive process. They're just happy to have an asset to buy. Right. And so they're getting deals done. And I think that's had an interesting impact on pricing because everyone thought, we had a decade of multiple expansion. And then with the market turning, everyone thought prices were just they were gonna come down. And look, they did over the course of 2022. They did come down, but they didn't come down as much as I think anyone expected. And with this interesting dynamic that we have now with fewer assets in the market, while the market is turning and it's moving away from sort of the rampant seller market we had for so long, there's still these positive pricing pressures that exist that funds are willing to pay the prices to get their capital deployed. So I don't know what your thoughts are, but I haven't seen prices come down nearly as far as I would have expected.
Prices have not come down as much as I think people would have thought. The market's still strong for sellers. If you are a quality asset, I think that if you were not a quality asset, I think they're down more. But I don't think that buyers should expect them to necessarily come down that much more. But at the same time, I don't think sellers should think that prices are going to get back to where they were 18 months ago.
Yeah. I think that on pricing, I think the real significant impact is debt, right? The cost of debt has obviously gone up with all the interest rate increases. And interest rates finally in the recent February meeting, it was just a quarter of a point. It was less than the entirety of 2022, all the increases over the course of 22. So it's finally tapering. We've had some positive indicators on inflation. So there's a sense that the cost of debt is sort of now priced into the market, right? We kind of have a sense of what it costs, to incur debt for a new platform. The trick is that the impact that the impact that the cost of debt has had is that the capacity to pay the purchase price has gone down, right? So in order for a fund, incur a new platform, senior debt, they have certain fixed charge coverage ratio that they need to hit. They had a fixed charge coverage ratio that they needed to hit a year ago, but you can just borrow a lot less in order to meet that same fixed charge coverage ratio. So it's not that funds, there's a lot of people who had been wondering, as the cost of debt increases, are deals going to slow down, or is pricing going to fall because private equity funds aren't going to make as much money? It's not as much about that as it is that just to service the debt at the platform and hit your financial covenants, if the debt's more expensive, you just have less buying power. Instead of being able to come to the closing table with $300 million of debt with a certain loan to value ratio, that loan to value ratio has changed. And so now that same company, the platform, their fund, whether they want to or not, they only have $2 million of debt, $200 million of debt to show up with. They got $100 million less that they can pay, unless they kick in a whole bunch of new equity. And if you make up the gap with the equity, then your returns change, and obviously it's just a different world. So, I think the impact that the interest rate increases have had on debt, it's less about making sure private equity funds can make enough money, and more about, do they have the money to bid on the asset and pay the price that they would have expected otherwise.
Well, and another point that ties to that is making sure that the company is able to meet the covenants on an ongoing basis when there's still talk about a potential recession or supply chain issues, et cetera. And I think that as the banks maybe tighten those covenants a little bit, you really need to make sure that you're not running into an issue where you're going to run into any of your covenants sort of down the road, which factors into that as well.
Yeah, it's interesting because I think something we're not going to see in 2023 because it's a bit too soon, but over the next several years, something to watch is there probably going to be more distressed assets that are going to be coming, because for such a long time there were all these covenant light deals, extreme amounts of leverage, 7 times, whatever it is. And now with supply chain issues that you mentioned, impacts on the overall economy, market factors, companies are struggling, but they're not struggling enough to hit those covenant lights, right? And so I think they're sort of the ugly stepchildren in the portfolios of some funds. Struggling companies still able to service their very low, requirements under their debt. In the next few years, there are going to be some problem assets that are going to come into the marketplace. So 2-3 years from now, it'll be interesting to see, while those portfolio companies are coming up, coming ripe for exit. It'll be interesting to see how that makes its way through the market.
Yeah, my guess is you and I will be having a conversation on that exact topic this time next year.
Yes, we'll be talking about 363 sales instead of a robust market.
Exactly. Exactly.
So, look, I enjoyed chatting with you today about the private equity outlook for 2023. Hopefully, it was helpful for our viewers.
It's always good to sit down with you.
Yeah.
Good to see you, Jeremy.
You as well.